Imagine waking up on a calm October morning in 1929, believing America is richer, stronger, and more unstoppable than ever. The newspapers promise endless prosperity, Wall Street celebrates record highs, and millions of ordinary people feel like nothing can go wrong. Yet behind this perfect image, a silent countdown has already begun. Hidden beneath the celebration are pressures, cracks, and risks that almost no one can see. The question is simple but terrifying. How did a nation that seemed invincible on Monday end up on its knees by Friday? And could the same thing happen again? To understand the final hours before the 1929 crash, we first need to understand the decade that created it. The Roaring Twenties were a time of fast growth, rising wages, new inventions, and a booming stock market. Credit became easily available, margin buying became normal, and banks began using people's deposits to gamble in the market. Most Americans genuinely believed the boom would last forever. This belief was the root of the problem, because the moment a society believes the future is guaranteed, it stops noticing danger. Underneath the surface, major weaknesses were already forming. People were buying stocks with borrowed money, sometimes borrowing $9 to buy $10 worth of stocks. Big investors secretly manipulated prices through coordinated buying groups called pools. Banks were deeply exposed to the market, meaning their survival depended on stock prices staying high. Meanwhile, factories were producing more goods than people could afford, but investors ignored these warnings because optimism overshadowed reality. By 1928 and early 1929, the U.S. economy was slowing down. Car sales fell, production dipped, and farmers struggled. But strangely, the stock market continued rising. Wall Street became disconnected from the real economy. Newspapers kept promoting hope. Politicians assured everyone that everything was stable. The Dow reached record highs by late summer of 1929, even though the economic foundation was weakening. The stage was set for a collapse. The final hours began in late October. On October 21st, the market showed its first violent tremors when a wave of margin calls hit the system. 2 days later, the market fell again, and rumors about failing banks spread across New York. Anxiety grew. Then came October 24th, 1929, Black Thursday. When the market opened, it immediately collapsed. A historic 12.9 million shares were traded as panic swept across the trading floor. The ticker tape ran hours behind. No one knew real prices. In desperation, major bankers met in the J.P. Morgan offices and announced they would buy huge amounts of blue-chip stocks to restore confidence. For a moment, it worked. Panic slowed. Newspapers celebrated. But that calm was just the eye of the storm. The following Monday, October 28th, confidence vanished completely. Panic returned, and the Dow fell another 13%. The banking rescue from Thursday was now seen as a sign of weakness. Investors felt the system was collapsing, and the worst was still ahead. On Tuesday, October 29th, Black Tuesday, the market broke apart. More than 16 million shares traded in total chaos. People cried on the exchange floor, phone lines failed, brokers screamed across desks, and fortunes evaporated in minutes. This was the moment the countdown reached zero. The U.S. financial system had collapsed. What made this crash turn into a national disaster was the structural weakness beneath it. Margin buyers were wiped out instantly because they couldn't repay their loans when prices fell. Banks, which had invested heavily in the market, saw their balance sheets destroyed. And the worst part, there were no safety nets, no deposit insurance, no government rescue programs, no circuit breakers to pause trading. Once panic started, it had nothing stopping it. The economy was already weak from overproduction and declining wages, so the crash simply smashed an economy that was already cracking. Over the next years, the crash triggered the Great Depression. Unemployment hit 25%. Thousands of banks collapsed. Businesses shut down. International trade fell by 2/3. Millions lost their homes and farms. The people who once believed in endless prosperity now faced hunger and uncertainty. The government tried solutions, but many made things worse. The Federal Reserve tightened credit when it needed to loosen it. The Smoot-Hawley tariff created a global trade war that deepened the crisis. There was no deposit insurance to stop bank runs. And cuts in government spending increased unemployment even more. America paid the price for its mistakes. Now, nearly a century later, certain patterns from 1929 are returning. Markets again rise even when the real economy struggles. Debt and leverage are higher than ever, fueled by derivatives and complex financial tools. Banks continue to hold risky assets. Narratives of permanent prosperity repeat in new forms. Politicians reassure the public that everything is stable. The similarities are uncomfortable, not identical, but loud enough to serve as a warning. There are three major lessons from the final hours before the crash. First, every boom contains the seeds of its own collapse, especially when people believe the good times will never end. Second, leverage turns small corrections into massive disasters. Debt accelerates both gains and losses. And third, financial systems that lack transparency and rely on confidence rather than strength are always more fragile than they appear. The final message is simple. We don't study the 1929 crash to fear the past, but to understand the future. History may not repeat exactly, but human behavior does. The question we must ask ourselves is whether we will recognize the warning signs next time, or ignore them just like people did in 1929. If you want more deep dive financial stories and breakdowns like this, make sure to like the video, subscribe to the channel, and comment which historical event you want explained next. Stay curious, stay aware, and never stop questioning the stories that shape our world.